Hi, so a lot of you will know that I do suffer from confirmation bias. That is, I like to find things that agree with my opinion already. Now, the reason that I'm talking about this now is because of the fact that I recently started having a look at investment books so that, first of all, I could increase my own knowledge and also to share with you on this channel. And obviously, one of the big things that taught me everything from the beginning was losing loads of money to start off with in the market. And my biggest learning curve for me was losing that money and learning how not to lose money. And so that's the reason why I got this book, What I Learned Losing $1 Million. And for me, this book is absolutely fantastic. It explains in a lot of detail a lot of the things that I personally kind of struggled with to start off with in a much better way than I could ever do on YouTube. So, first of all, I do strongly recommend that if you get a chance, take a look at this book, read it. Okay, there's a link down in the description. It is an affiliate link to Amazon. So if you do buy it on Amazon with that link, it will cost you exactly the same, but it gives me a small kickback for recommending you. So obviously it helps to support this channel. So let's just go through a few bits in this book. I'll read you a few little paragraphs to explain what the book is talking about. So first of all, it's broken down into kind of three sections as such. The first part is all about the writer and his kind of story, how he got to where he was, and then what caused him to lose his millions, or his million, and then what he then learnt from it and how he kind of moved on to where he is writing this book. So that's the kind of first section, bit of an autobiography, and it's actually really, really interesting. I'm not going to read any parts of that. I'm mainly going to focus on the lessons at the end. So, like I say, to be honest, even just for that part of the story, I think this book is absolutely worth reading. The lessons afterwards are kind of like a bonus. So the second section then kind of goes into explaining the methodology behind it. And then the third section is kind of like an extended conclusion. So it kind of just sums up all of the different kind of teachings and learnings from the middle section of the book that were all gained from the first section, if that makes sense. So the end of the second section, the paragraph at the end is, to repeat the motive of the book thus far, people lose, and that's really lose, not just have occasional losing trades, because of psychological factors, not analytical ones. They personalize the market and their positions, they internalize what should be an external loss, they confuse the different types of risk activities, and they make crowd trades. Is there a single factor common to all of these errors, and can we determine a way to address that factor in order to avoid these errors? So, like I say, all of those kind of bits are broken down fully and explained what they are in the middle second section of the book. So then when you move into the third section, it kind of explains the kind of elements a little bit more. So let me just read this bit. Consider the following story about an individual investor reported by the Wall Street Journal. After seeing the nearly 87% return the 20th Century Investors Ultra Fund racked up in 1991 by concentrating on biotech and computer-related stocks, he took a plunge, paying about $18 a share for the Ultra Fund. A year later, with Ultra shares below $15 a share, he felt stuck. So this is kind of talking about the psychological factors of once you've kind of invested, if the stock that you've been watching drops in value, then having that kind of mentality of it's dropped a bit, So if I sell my position, if I close, what will happen is I will lose all of that money. I will lose the money that's actually dropped. But if I don't close that position, I haven't lost it yet. It's only if I close the position that I've lost that money, which is an absolutely ridiculous way of thinking about it. Okay, once the stock drops, that money is gone. Okay, there is no guarantee that that stock is going to go back up to where it was. So when you kind of hear people saying about, don't close because that will kind of concrete your loss, that locks your loss in some ways it is true, because, for example, if you've got a stock that's climbing and it takes a little dip and they've kind of bought in at a sort of temporary peak, then that is kind of concrete in your losses. But that's not always the case, because obviously if you're buying at a peak of a bubble or, like this one, then there is that kind of fact that actually this stock was the highest it's ever going to be, and that's kind of where you bought in, and now it's going to go down. So it's understanding really like the fundamentals of the business that you're investing, or the stock that you're investing in, and really kind of knowing whether it is actually going to be worth the price that you've paid for it, or the price that you're expecting it go to. Not just kind of blindly buying in on an asset that you think could be worth that at some point, but you don't actually know. So then another part of the book goes on, the next step in decision making is establishing controls, i.e. the exit criteria that will take you out of the market, either at a profit or a loss. They take the form of a price order, a time stop, or a conditional stop. I.e., if a certain thing happens or fails to happen, then you are getting out of the market. Your exit criteria create a discrete event ending the position and preventing the continuous process from going on and on. Okay, and that's really, really important. So some people will use stop losses, and obviously that's what the book's saying there. Like, there's different types of kind of notifications of when you're going to get out. Now, I personally don't use stop losses because I find that you can sometimes get hit by volatility in the market, and that can kind of close your trade at the very bottom. I generally tend to kind of use other markers within the market, but being very kind of fixed on, before you go into a trade, knowing exactly what it will be that will get you out of this trade. Because what a lot of people do is they will justify various different things, and the book kind of goes into that in great detail, and there's a few more bits that I'll read out in a second. People will justify what's happening as part of kind of staying in their position, So that's why it's very, very important to kind of, before you get into a trade, have very kind of fixed criteria of, if this happens, I will get out. You need that exit strategy, because if that happens, you need to make sure that you don't start explaining it away. So a big kind of chunk of this book is, like I say, it's all about the psychology and your kind of mindset when you're in the market. And it talks about the difference between betting, gambling, and investing. And effectively what they're saying is, if you're doing it just for fun, in the same way as if you go to a casino, you're happy to just chuck $20 down, or $2,000 or $200,000 down in the chance of winning X amount of money. But really, you're actually doing it for fun, not because you really want the money, just as it's entertainment. And that's gambling. Betting is when you specifically kind of personalize it. So, for example, I think stock X is going to reach price X. And when it does, you almost kind of take it as a personal success. And if it doesn't, you take it as like a personal failure. Now, many of you will know, to an extent, I kind of do fit into that category. I do kind of end up almost betting a little bit. And even after reading this book, I don't necessarily see that as wrong. I think in this book, he kind of does steer you towards that not necessarily being the right kind of mentality. But I think it's, with regards to a stock, I think it is still quite important because of the fact that you are, no matter what you do, you are still betting. By investing, you are still expecting the stock to go to a certain point. So that's kind of my kind of take on what his kind of mentality is with this book and how he's explaining it. And then obviously he's saying with investing, you're kind of very methodical about it, and it's just a case of, I'm putting this money in because this price is going to hit, it's going to go up, and I will take it out when it gets to X point. Again, like I say, I have a bit of difficulty understanding how a lot of what he says with investing isn't actually betting. And maybe if you do understand the difference, then please by all means leave a comment below, and maybe you can explain it to me better. So on that kind of note, a bit that he says is, a preoccupation with wanting to be right or wanting to be perceived as being right explains people's tendencies to focus on why the market is doing what it's doing instead of what it's doing. They're constantly asking, why is the market up or down? And when someone asks, why is the market up, do they really want to know why? And that's a very kind of big part of what he's saying in the book, is the fact that a lot of the time people are looking almost for that confirmation bias. They're going, like, they've got a long position, the market starts to go down, and they're kind of going, what is it that's causing the market to go down? Well, that's ridiculous. That shouldn't cause the market to go down. And obviously, if you watched one of my recent videos about the market crash, you'll know that to an extent I was doing that recently. Is that necessarily wrong? Again, it's not something I strongly agree with in this book. I'm not really sure that that's necessarily a bad thing. It's a bad thing in respect of ignoring the facts, but I don't think you should necessarily think by disagreeing with the market and by disagreeing with what's causing things that's necessarily bad. It's more to make sure that you're not doing it blindly, that you are kind of looking at the reasons why the market's going down. If you're long and the market's going down, you need to understand those reasons why, and you shouldn't just dismiss them. You should really kind of look into them, understand why, and then understand if that really should be affecting your position and whether you think it should make a difference. And to blindly kind of just shrug it off and go, oh, that's ridiculous, that's when it becomes a problem. And that's what a lot of people do. So you should remember that participating in the markets is not about egos and being right or wrong. It's not about entertainment. It's participating in the markets is about making money. It's about decisions being implemented by a plan. And if implemented properly, it's actually quite boring, waiting for your buy or sell criteria to materialize. The minute it starts to get exciting, you are gambling. Now, again, this is where I have a slight disagreement with this book. Maybe it's because I'm a bit of a geek, I don't know, but I most definitely don't consider myself a gambler. I would never go into a casino, I would never go on to horse racing, I would never do anything that I believe risks me money. Now, obviously, anything in the stock market is risking money because you could be wrong. But as far as I'm concerned, I really, really enjoy watching the numbers move up and down. I really enjoy being part of the stock market, and I really enjoy reading up on companies. So for me, this is exciting. And I don't think necessarily that should be an issue. But at the same time, I do understand how it could be an issue for some people. And maybe if you are enjoying it too much, maybe you are gambling. So maybe it's more, what you should do is, if you are enjoying it, you should be double checking to make sure that you are not gambling and that you are investing properly in the market and understanding exactly what you're doing. So there's one particular kind of bit he said in here about it not being, about not taking it personally, and he's used a bit about Edison, and he said, remember, Edison didn't take the failures or losses personally, and he succeeded brilliantly. Now, for me, there's actually a quote from Alfred in one of the Batman films that kind of links into this. And I'll play a clip in a minute to explain that kind of quote. So, but first of all, so he's saying about Edison's not kind of taking those losses personally, and that's what kind of helped him to continue to keep chugging away until he finally was successful. And this is the quote from Batman.
Why do we fall? So that we can learn to pick ourselves up.
And for me, that quote is very much, when you, same with this guy, you know, at the end of the day, he fell and then he learned to pick himself back up again. And for me, that's kind of like the same experience that I had. You know, in 2018, I ran and fell flying on my face as far as the stock market goes. But I learnt to pick myself up, and I believe that as I'm going forward, as I'm spending more and more time in the market, I'm learning more and more about what's happening and what's causing various different things. So the next part of the book I want to read you. When it comes to the market, you're supposed to do what feels good. If you deviate from your plan and the market starts going against you, what are you going to say when I knock on your door and ask, well, are you having fun? Is this an enjoyable experience? You're going to say, no, this is not fun. Looking at those prices going down is not fun. You know what you should do. Don't go looking for supporting evidence or reasons to stay in the market. Do what feels good. Get out. There is an inverse relationship between your threshold for pain and success in the market. So as soon as you feel the pain, get out. What if you have a long position and prices are going up? Does that feel good? Do you know what you're supposed to do? Keep feeling good. Leave it alone. It's working fine. Stay with positions that make you feel good. Get out of positions that make you feel bad. You'll know when you feel bad. If you can recognize anything, you will recognize that this doesn't feel good. The minute it doesn't feel good, stop doing it. It's that simple. And I think that's really, really good, like basic advice, in the regard that when you're kind of fairly new to trading, you almost need to kind of do that as a very basic principle. You know, this doesn't feel good. It's really stressful. I need to get out. And first of all, I mean, it's good for your own mental health, because sometimes sitting in the market and watching it kind of go up and then down and then up and then down, it can be terrible. You can spend all your time looking at your phone, checking the market, and completely ruin any time that you have with your family. So it's really, really important to make sure that you're doing what feels good, that you're happy when you're in the market, because if you're not happy, it's not a good thing to be doing, is it? So it's, for me, that's kind of like quite a key point of make sure that you're happy in what you're doing and make sure you're happy in your position. Now, on the flip side of that, be prepared that if you are going to invest in volatile stocks, you will suffer pain, because obviously the volatile stocks will go up, down, up, down, up, down. So when they go down, that's going to hurt, and you need to be prepared for that. So be aware of that situation. Now, the book then kind of goes into talking about CEOs and managers and entrepreneurs and how they kind of, sometimes they kind of have a bit of success and then they kind of get this like Midas touch, and then everything kind of collapses around them because they're like, they think they're amazing and they think everything they touch is going to turn to gold, and it doesn't. And you get a lot of investors and traders like this, that they come into the market, they get very, very lucky to start off with, and then they think that they know everything that they're doing. They think they're an expert, and it means that they then start just taking blind risks and doing things that they probably shouldn't be doing. Now, obviously, potentially, I could have an element of that because I had my kind of bad time in 2018, and then kind of since that date when I started doing this properly, I've had a lot of success. So there is the chance that, that success could have gone to my head a little bit, and I could think that I'm better than I am. Now, I know sometimes that can probably come across in videos that I do. I can come across quite patronizing when I'm talking on Facebook and other things as well. That's more of an outward thing. So while I may be outwardly very confident, there's a lot of stuff that I do in the background on checking up on everything that I do and second guessing myself all the way through. So while I may seem very overly confident in what I'm doing, the reason for that is often because of the fact that I'm actually doing quite a lot of stuff in the back to kind of make sure that I am right and second guessing myself. So, and I'm constantly kind of going over everything that I'm doing to make sure that what I am doing is the best option. So, but to come back to the line in the book, I've seen people who have been at certain places at certain points in time with a good idea, and they did fabulously well, and they didn't have a clue about what to do next. They're not good advisors, and they're not repeat entrepreneurs. And there's a process of assuming, based on what you've succeeded in doing in the past, that you're a genius. And now, like I say, there's obviously a big element of that with regards to investing. But I think there's also a really big element of that in regards to businesses that you're investing in, CEOs that you're investing in. For me, when I invest in a company, I very much look at the management team. I want to know exactly what they've done, and I'm not just investing in the business, I'm investing in them. And that, for me, is very, very important, because you need to understand what the CEO, what the management team has done, and whether they've been lucky or whether they've kind of done this through skill. Now, for me, a very big kind of thing, a good example of this for me is Mark Zuckerberg with Facebook. Now, obviously, Mark Zuckerberg has been tremendously successful, but when I look at his business, the way that he conducts his business, the way that he created Facebook, for me, I see someone who managed to get the right idea at the right time and has just been incredibly lucky with regards to that. Now, don't get me wrong, I'm not saying he's not very, very intelligent, and I'm not saying that he doesn't have some very good ideas. But I think if he had not created Facebook, I don't think he would have created a different business that would have been just as great. Now, when you look at someone like Jack Dorsey, who started or helped to co-found Twitter and also Square, And then you look at people like Elon Musk, who have started multiple businesses. You kind of see the difference between these are people that really understand what they're doing, and they're able to do this multiple times. So for me, that's like a very, very important thing of checking the business that you're investing in and working the best way to do it. So I'm going to end with the last paragraph of the book. Rather than looking for a formula for success to follow, this book has identified the formula for failure to avoid. As Anne Wang, founder of Wang Laboratories, said, "It is my belief that there are no secrets to success. The formula for failure is not lack of knowledge or brains, skill or hard work, and it's not lack of luck. It's personalizing losses, especially if preceded by a string of wins or profits. It's refusing to acknowledge and accept the reality of a loss when it starts to occur, because to do so would reflect negatively on you." So, to sum it up, what I learned losing $1 million, fantastic book. A lot to learn in here for any potential new investor. So if you are new to investing, I really think you should check out this book. And as I say, if you are going to buy it, please do it on Amazon using the link below to help support this channel. Anyway, that's all for now. Thanks for watching. Don't forget to subscribe, and I'll see you in the next video.